APT and multi-factor models are what we're going to be discussing now. So these are extensions of CAPM for determining the risk-return relationship for an individual stock. So a single factor model says that the expected return, or in this case excess return, on a security is equal to beta times a given factor plus an error term. Beta is a factor sensitivity or factor loading. CAPM is a single factor model where the beta is how the stock reacts to changes in the market. So you can have a variety of different single factor models. So in this case, this is written in the generic form where F is the macroeconomic variable. F could be positive or negative, but has an expected value of 0. Okay, and then firm specific risk is that error term, sorry. Multi-factor models use more than one factor to predict markets' rates of returns. So it's basically running a multiple regression and then getting the beta coefficients on those additional things. So instead of just CAPM, which we found that beta coefficient as a single regression where we had only one independent variable, the market return, that was used to predict your stock's returns. With multi-factor models, you use additional things. So one example would be using GDP and expected inflation. So more than one factor, the expected return is equal to, so some people use GDP, inflation, interest rates, and that's what we're seeing here. And you estimate each of those by running a regression, and then those coefficients are called factor loadings. Arbitrage pricing theory is based on the law of one price. So loop, as you may have learned in econ. If two assets are equivalent in all economically relevant aspects, then they must have the same market price. So you see law of one price tested when they do the Big Mac index, because the Big Mac is 2 all beef patties, special sauce, lettuce, cheese, pickles, onions on a sesame seed bun, and it's supposed to be the same thing no matter what country you're in. So what's interesting is testing, does the Big Mac in fact have the same price after accounting for exchange rates in every single country, because it is in all relevant aspects the same, so it should have the same price. And if it's not, then there would be an arbitrage opportunity or something where you could make a risk-free profit. So the Big Mac is something that you can consider, but we would also say, by the way, the Big Mac index is reported by The Economist each year. You can look that up. But we would also say that this would apply to any asset. So if you have a share of IBM trading on the London Stock Exchange, it should have the same price as a share of IBM trading in the US. So that's the kind of idea. And if there are any mispricings, you would be able to make a risk-free profit. So if there's risk-free profit, the degree of risk aversion and wealth are irrelevant. So arbitrage occurs if there is a zero investment portfolio that has a short profit. Guys, say hi. Hi. Okay, now go back to eating. Yes, they know. Since no investment is required, investors can create a large position to obtain these profits, and this is because there's no net position. You're borrowing and then buying, and because you're sure of both of the prices, you're locking in a risk-free profit. Okay, so if this is a well-diversified portfolio, then the error term would approach 0. Guys, get out. The no arbitrage expectation or equation for APT says that the expected return of the portfolio is the beta of the portfolios times all of the market's rates of return. It applies to all well-diversified portfolios, and it implies that the alpha value is equal to 0. So this would say that if it is possible to find factor loadings that meet this, then there would be no unexpected returns. So in essence, the SML would be CAPM for a well-diversified portfolio. Multi-factor APT uses more than one single factor. So the factor portfolio is a well-diversified portfolio constructed to have a beta of 1 on one factor and 0 on the other, and you track one macro factor that is uncorrelated with the other. So the factors are important to the performance of the general economy. So these are any macroeconomic factors that might be of interest. Usually you'll see GDP in there. You can also talk about the money multiplier, those kinds of things. Firm characteristics would not be included in the multi-factor APT. The Fama and French three-factor model is a multi-factor model, and this says that the return on a stock at time t, ow! Get off my foot! RI is the return on stock I at time t is equal to alpha of I. So this is saying there will be some firm-specific alpha value, but on average, and this model doesn't make a prediction about on average whether the alpha will be positive or negative. And then the beta of the market, and then small minus big, which is SMB, that's how they abbreviate it, and that's going to be a measure of firm size. And then high minus low is a market to book ratio. These pieces of information are available online, and I'll show you how to download the SMB and the HML variables for each of these. And then, are the firm-specific characteristics correlated with the actual but unknown risk-specific factors? That's really what we are trying to figure out here when we're using this. So if the Fama-French three-factor model works and it does predict your returns, then you would say that these factor loadings or these beta coefficients are statistically significant and they should be used to estimate your price.